Hi everybody. In this video, we'll practice writing journal entries for merchandising businesses. This is a continuation of the Chapter 4 Study Guide number 1. We will continue using the same worksheet that we began in that video. On January 26, 20X1, Sellers Company sold merchandise in the amount of $15,800 to Buyers Company, with credit terms of 110 net 30. The cost of the items sold is $9,000. Sellers uses the perpetual inventory system. The journal entry or entries that sellers must make on July 26 to record the sale is or are. Please pause the video, write your journal entry or journal entries, and when you're finished, start the video again to check your work. For every transaction regarding the purchase or sale of inventory, the first thing you should ask yourself is, are we doing the transaction for the buyer or the seller? And in this case, we are writing the journal entries for the seller for the sale of merchandise inventory. Under the perpetual method, there are always 2 journal entries required to record the sale of merchandise inventory. The first journal entry is to record the sale, and the second journal entry is to record the cost of sale. So, debit accounts receivable for $15,800 and credit sales for $15,800. Then debit cost of goods sold, $9,000, and credit merchandise inventory for $9,000. Note these are 2 separate and distinct journal entries. Given the same facts as number 8 above, show the journal entry or entries that Buyer Company will make on its books for their purchase from Sellers Company on July 26th under the perpetual inventory system. Under the perpetual inventory system, when the buyer purchases merchandise inventory, it requires only 1 journal entry. Debit merchandise inventory $15,800 and credit accounts payable $15,800. We know that we do not credit cash because there were credit terms. If had this been a cash sale, it would have told you that it was sold for cash. But also, if there are credit terms don't apply to a cash sale. They only apply to a sale made on account or a purchase made on account. Number 10. On October 1st, 20X1, ABC Company sold merchandise in the amount of $24,000 to Buyers Company with credit terms 110 net 30. The cost of the items sold is $18,000. ABC Company uses the perpetual inventory system. Buyers pays the invoice on October 8th, 20X1, and takes the appropriate discount. The journal entry or entries that ABC makes on October 8th when they receive payment from buyers is or are. Now, when you run across something where there's an original transaction and then something that happened a little later, and it says specifically what is the journal entry on October 8th, then don't write the journal entry for October 1st. Only write the journal entry for October 8th. So pause the video, write your journal entry that ABC would record when they receive payment from the buyer on October 8th. The first question to ask yourself is, are we recording the journal entry for the seller or the buyer? The ABC is the seller of the merchandise inventory. It says ABC sold merchandise inventory. So we are recording the receipt of cash for this sale from the seller's point of view. We can do some calculations. This merchandise was sold for $24,000, so $24,000 times 1% equals a sales discount of $240, and $24,000 times 99% equals cash that ABC will receive of $23,760. Debit cash, $23,760. Debit sales discounts, $240, and credit accounts receivable, $24,000. Given the same facts as number 10 above, show the journal entry or entries that buyer's company will make on its books for their payment to ABC Company on October 8th under the perpetual inventory system. In this case, we are recording the journal entry for a person that purchased merchandise inventory and they are now paying the bill. The same calculations apply. $24,000 times 1% is a $240 discount. $24,000 times 99% equals $23,760 cash that buyers will pay. Debit accounts payable for the full $24,000. Credit merchandise inventory for $240. And credit cash for $23,760. I hope this credit to merchandise inventory was not a surprise to you. Remember that all discounts will reduce the merchandise inventory from the buyer's point of view. Number 12. On November 1st, 20X1, Roberts Company sold merchandise in the amount of $10,800 to Buyers Company with credit terms of 210 net 30. The cost of the items sold is $7,000. Roberts uses the perpetual inventory system. On November 4th, Buyers returns some of the merchandise to Roberts. The selling price of the returned merchandise from Robert's point of view was $1,500, and the cost to Roberts of the merchandise that was returned is $950. The entry or entries that Roberts, the seller, must make on November 4th when they receive the returned merchandise inventory is or are. Roberts is the company we're making the journal entries for. Roberts is the seller. 2 journal entries are necessary to record the return of inventory sold. The first journal entry is to reverse the sale, and the second journal entry is to reverse the cost of goods sold and put the merchandise inventory back on the shelf. Debit sales returns and allowances, $1,500. Credit accounts receivable, $1,500. Debit merchandise inventory, $950. And credit cost of goods sold, $950. Given the same facts as number 12 above, show the journal entry or entries that Buyers Company will make on its books on November 4th when they return some of the merchandise to Roberts Company under the perpetual inventory system. When the purchaser returns merchandise inventory, their journal entry is only one entry, and it's a debit to accounts payable, $1,500, and a credit to merchandise inventory, $1,500. Number 14. On December 12, 20X1, XYZ Company sold merchandise in the amount of $14,700 to Buyers Company with credit terms of 210 net 30. The cost of the items sold was $10,500. XYZ uses the perpetual inventory system. On December 15, 20X1, Buyers negotiates with XYZ for a $900 reduction in price on some of the merchandise that did not meet the specification of their order. XYZ's cost of the merchandise thus reduced in price was $640. Show the journal entry or entries that the seller, XYZ Company, makes on their books on December 15th to record the amount of this price reduction on the merchandise. This is not a sales return, it is a sales allowance. XYZ did not receive any inventory back from Buyers Company. It only allowed buyers a reduction of $900 in the price that Buyers has to pay for the inventory that did not meet the specifications. XYZ is the seller. Only one journal entry is necessary to record this sales allowance. Debit sales returns and allowances, $900. Credit accounts receivable, $900. That one was tricky because you were given more information than you needed. If this had been a sales return, you would have needed the second journal entry and you would have needed to use this $640. But because it was a sales allowance, this $640 was superfluous information. You did not need that. Given the same facts as number 14 above, show the journal entry or entries that Buyers Company will make on its books on December 15th to record the price reduction under the perpetual inventory system. The purchaser shows the reduction in price as a reduction in the cost of the inventory that they purchased. Debit accounts payable, $900. Credit merchandise inventory, $900. Number 16 and 17 does not refer to any fact pattern. It simply says, number 16, the company paid a $50 freight bill on inventory it purchased. This is a freight in example. How would you record that journal entry? Freight in always increases the cost of the merchandise inventory purchased. So debit merchandise inventory, $50, credit cash, $50. Number 17, a $100 freight bill was paid by the seller to ship inventory to the seller's customer. This is a freight out example. How would you record that journal entry? Freight out, recorded by the seller to ship inventory to a customer, has to be charged to an expense. You could have charged it to freight expense, you could have charged it to shipping expense, but it has to be an expense. I chose to call it shipping expense, $100 debit, cash, $100 credit. Well, that's all for the Chapter 4 study guides. I hope this information is helpful. See you next time.